Asian credit markets have been very volatile since March. We have seen a large risk-off move across global assets. Global credit experienced a dramatic spread widening, and Asia sold off, especially in the high-yield space. As we all know, it's primarily driven by the coronavirus and related economic disruption. Fundamentals took a negative turn with sudden stoppages across a variety of businesses over the last few weeks. In addition, the oil price declined precipitously due to failed OPEC Plus negotiations in early March, which compounded problems for the energy sector, even though talks was recently revived. There are also technical pressures in the market. One of them is the demand for cash, as many businesses now face a cash crunch, with the top-line revenues not coming through. Coinciding with that, risk appetite also is very much curtailed by the spike in volatility and reduced ability for market participants to trade due to lower liquidity. The good news is that government have acted swiftly to address liquidity concerns. Measures from the Fed are beginning to calm credit markets in Asia as well. There has been material improvement since the middle of March with various funding programs. While Asia credit has widened quite significantly in terms of credit spreads, it has behaved generally in line with U.S. comparables. China can be a good roadmap for other countries given it entered the lockdown first. We are seeing high-frequency data showing a slow recovery trajectory, to varying degrees in power consumption, factory capacity, and property sales. There's still a lot of uncertainty and the potential for a second wave impact, both in terms of infection and global demand destruction. We estimate that production levels could only return to the late 2019 levels sometime in Q4 this year or Q1 2021. The dilemma is while policymakers would like to stimulate through fiscal and monetary means, given China's earlier work on deleveraging, it would aim to avoid excessively large credit-driven expansion. If you assess the time that has passed since the disease first broke out, and for the market and public to better understand it, it has only been about 2 months. Many of the companies we have talked to are still trying to grapple with their appropriate response plans, such as what kind of capital expenditure they can cut and whether they should tap the credit lines that they had prepared earlier. We are seeing a wide dispersion in how they address these challenges among the companies we talk to. The default number is likely to be higher than we expected before the virus situation emerged, but as far as how high, that is still a question we are assessing. But what we can share is that the market is quite forward-looking and has handicapped this unprecedented and severe situation as best it can into pricing. As long as the default rate isn't worse than what we saw in the global financial crisis, there seem to be areas of value right now. Looking at this question from a different angle, in the Asia high-yield market, 2020 is not a particularly large year in terms of maturities for dollar-denominated credit issuance. With many issuers managing to refinance early in January, the problem may not be as acute for issuer as long as they can pay the coupons. A bigger test will be coming in 2021. In terms of sectors, we have a constructive view on utilities, which have shown to be more resilient in previous volatile periods, and banks, which in general are in a healthy state fundamentally. Tech will continue to have structural growth, particularly given social distancing and new measures to work from home. Business trends will continue to shift to a flexible workforce, and cloud computing-related companies should see decent business even in this disruptive climate. Credit spreads have widened quite a lot, but it is important for investors to remember that cheap does not necessarily mean good. Credit differentiation will be even more pronounced, and it is a good time for active management to be selective, to be disciplined, and patient when it comes to the redeployment of capital.